Hey everybody, happy 4th of July. I'm going to talk about some of the things I'm looking at here, both on the fundamentals and the technical side. Thinking about possibly doing an interfund transfer here in the near future. Not set in stone yet, but it's a possibility. I do want to swing back out to G Fund soon if I can, although I do have some other reasons to be concerned about doing such a move right now, and I'll get to that a little bit later. But it just some thoughts are in my head, and yeah, I'm going to show you all a little different things I'm looking at, and also give some of you guys a little bit of an education on some of these technical chart indicators that some swing traders might actually look at, and explain them a little bit. Okay. Um, I'm going to start by showing you first, just with the TSP prices alone. It's from a template I have that's actually in the file section of the group on Facebook. And it has a few indicators like just on a numbers on a table basically that throw little flags here, like with conditional formatting flags, basically color the cells um, to give kind of indication on what's going on with that area. All right, so let's check them out. Okay, so this is a table that's in my TSP template file spreadsheet that you can actually find in the file section of the group. Basically, it's just showing you the FCS and I funds. Obviously, I don't care about the G fund because it only ever goes up and at about the same rate as the 10-year Treasury notes yield. So we already know that the G fund's only going to move around 2% per year at the moment because that's where bond yields are currently at. But we do like to see what's going on with the other funds that can go up and down in price. Give you kind of an intro on what this table is actually showing us here. So as you probably figure out here, the current prices are right here. Basically, this is the July 3rd prices, which is yesterday. Um, then you have the four moving averages I like to look at: the 10-day, 50-day, 100-day, and 200-day. Basically, if you take the closing price from every day for for those number of periods, that's what the average price is. That's what that means. So for those of you who are brand new to swing trading or whatever, or technical analysis, I should say, that's basically what a moving average is. So, and the shorter the average is, the more quickly it changes. I'm going to show you in the chart a little bit later here how that actually looks using the S&P 500. But when you see all these are all green like this, that means that the current price is above each of those particular areas. So all four funds are currently above all four of the moving averages that I look at. Okay, so that means that we're in an uptrend. Basically, that's it. So we'll have to look at more of this information here to know what else is going on here. Okay, this next indicator here, RSI, is a very, very common indicator that people use. It stands for Relative Strength Index. Um, Basically, it's really a flag to show to look for possible signs of overbought and oversold conditions. Generally speaking, the most common parameters that people use for RSI, I believe, is about 10 days or so, maybe 14 days. And I mean, as far as what kind of period they're looking at, and any RSI reading above 70 is generally considered overbought, and then anything under 30 is considered oversold. Now, it doesn't always work that way. I have in the past from using this chart, which I haven't used in a while, but I figured I'd go ahead and look at it again and give you guys some information on it. When we were in, what year was it? Yeah, earlier in the earlier days of when I first created this chart, basically, or this table here, I regularly saw the RSI actually get up more into the 75 or so range before prices would drop, and then the RSI would only drop to about 40 or so during the dips before the next rebound would happen. It would be like clockwork. Literally, as soon as it dropped below 40, the very next day the price would bounce. So I wouldn't use, I wouldn't use 70 and 30 as like a set in stone indicator that, hey, prices are probably going to reverse or stall out or change or, or not, or just sit in a tight range, whatever, from where they currently are. Um, I'm going to go more into the weeds with this RSI indicator later when we get to the chart and explain how it actually works, okay? Just know that right now the FCNI funds are all giving basically overbought indications here. S fund is starting to get up there, not quite there yet, but it's getting there. So these are things to consider. That maybe this rally might be topping out soon. Doesn't mean that we're going to go into a downtrend next. It could just sit and move sideways for all we know, and then these numbers can recover back to a more normal range. And I'm going to explain that later, and you'll understand a little bit better, hopefully. Just know that right now, all but the S fund are giving overbought indications on the RSI, at least. Moving on to the histogram here, this is something that basically I derived from another indicator you're going to see on a chart, on the S&P 500 chart that I'm going to show you. Usually comes with the moving average convergence and divergence, or MACD indicator. And I'll explain that when we get to that point. There's basically three. The way I have it calculated here, usually as you see here on the S fund, how the cell turned red, that's where I have it set to automatically trigger. Hey, this is an overbought condition, possibly. So basically at 0.05 or above, it's considered a short-term overbought condition, and anything at or below negative 0.05 is considered oversold. Now, sometimes it does change direction at plus, like at 0.3 or 0.4, for example. But that's another indication that we're probably getting toward the back end of at least the current rally. It doesn't mean that we're going to see a downtrend next. Like I said, it could go, like I said, it could hover for a little bit and then continue upward. So just keep watching. Okay, next line here. This is a 52-week high. So this is the highest price that each of these funds has seen in the last 52 weeks. And as you'll see here, between the percentage and dollar amount off the 52-week high, you can see that the FCNI funds are all actually currently at their 52-week highs as of yesterday. Actually, the C fund was already hitting highs, I think, the last few days. When I checked on the second, with the July 2nd prices, the I fund was just below it, only I think by 40 cents or so. But as you see here, it actually got above it with yesterday's prices. So we are looking good here as far as, for momentum. We actually like to see prices at or near 52-week highs and not near 52-week lows. As you see here, we have distance in dollars and percentage amounts and all that from the 52-week low. These are the 52-week low prices. What percentages were really good distance above the 52-week lows, as you see. In the last year, we're getting close to 30% difference between how low, what the bottom was in the last year and where we're at now. And as you see here, dollar amount, it's these share prices have changed quite a bit in just a 1 year period. So it's quite profound how much you can miss out on if you're scrambling to the G fund and to avoid losses, and then have a rally turn back around and take off without you in it, and you can stand to lose a whole bunch by doing that. So be very cautious with that. Swing trading, you normally want to be swinging out when prices are at or near highs anyway, but just for the buy and hold people who could be watching this, that's another reason why moving out to the G fund at a really bad time can seriously do a lot of harm to your account. All right, so next I'm going to cover this next section down here called the moving average spreads. Basically, it's a comparison of by percentage of what's going on between the current price and each of those averages, and then each of those averages relative to each other as well. Now, obviously, the shorter the average is, the more rapidly moving it is. So the more likely it is to be on the high above the slower one, or on an uptrend, or below the the slower trend on a downtrend, or slower moving average, whatever. Anyway, some of these from past analysis, I came up with an estimate of what the design here is to figure out how stretched or collapsed the average spreads are. Because usually when the moving averages get so far apart from each other, it becomes more likely that they're going to revert to their means, which is all in about the same ballpark. Where they collapse and tighten up, whatever. So I figured out what basically at a previous point in time. Um, how much the percent of difference is before a trend reversal is likely to occur, and of course they'll actually trigger red flags here as well when it's indicating that there might be a trend reversal here in the near future, or even if it's just a short term reversal. So as you see here, the current price relative to the 10-day average, all three of the stock funds are more than 1% above their 10-day moving averages, which is where I think I have the flag set on this. It's been a while, like I say. I'd have to look at my conditional formatting rules to confirm that, but I recall this being about 1%, the point where I tripped this to make a red flag. And moving on to the current versus 50-day, right at 4%, I'm pretty certain is where I had that one set at. As you see here, the C fund is at that point now, which is the S&P 500, so we can get a look at that in a bit. And then the S&I funds are still not quite there yet. They could stand to go a little higher before that'll really create a red flag condition as far as that spread is concerned. Current versus 100-day, it's been a while. I want to say I have it at 6%, but I could be wrong. It makes sense because the current versus 100-day on the C fund is currently at 5.47%. So, and it hasn't tripped the flag yet. So it's another indication that it's probably at 6% where it trips. 200-day, I honestly forget. I'm not even going to venture a guess what I have it set at without actually looking at my spreadsheet and looking at the rules I have set. But yeah, as we'll see, the C fund is over 8% above the 200-day moving average. So basically, it's a good distance above all four of these moving averages. So it's another. All these are indications that probably not going to keep growing too strongly over in the next short-term period. There's plenty of more growth to be had in the over the coming months. And you'll see that from my chart data that I'll show you, both on the fundamental side mainly, but short term, looking at possibly a top out or a trend like a downturn here in a little bit. And then same with the moving averages relative to each other. I don't think I have flags set on them, but I'm more interested in knowing how far apart they are from each other. If they're within like less than 1% of each other, then that's usually a good sign to me. It's they're all bunched up a little more tightly. In fact, if they're more like 0.5% off or something, that's even better. When moving averages are all bunched up together, they tend to be a lot. There tends to be a more a prominent rally or a prominent price drop, whichever the case may be. It's basically the prices might hover in the area of where the moving averages are all lining up together, and then once the price does establish an uptrend or downtrend, it usually goes really fast from there. Not always the case, but it's one thing to look for on the technical side. All right, so that should cover enough for this chart here. I'm going to go ahead and move on to the actual price chart for the S&P 500 now and show you, start with the fundamentals. The fundamentals, this is basically my price points or my price targets that you can also find in the announcement post in the group. And then I'll go on to some of just a few of the technical indicators that I look at. There's a lot more that can also be looked at on the technical side. It's just a few of them that are tools in the toolbox really to look at for ideas. All right, so that's all for this part. Okay, so here's the S&P 500 chart. I have it set at daily and 1 year at the moment. I'm going to go ahead and put my price targets in here first. They should be showing up already. Alright guys, this is the chart that I use. It's from Ameritrade, Thinkorswim platform. Basically, I'm showing you the S&P 500's price chart right now with candlestick pattern, and yeah, the drawings I have in here right now are my price targets based on my earnings fundamentals, and these are the numbers that you can also find in the announcement post on the Facebook group. So I'll give you a little bit of a refresher on how this works for those of you guys who might be new to this. Let me zoom back out actually. Okay, so the buy and hold, basically the current price, current value of the index is right where this white line is, where it says current value 3030. Okay, that's based only on trailing earnings. That's where I think the index could be valued in a zero growth environment. And we have positive growth expectations right now over the next year. So what happens is over the next year, I'm expecting the index to rise to a value of 3245 between now and next year. So, and what as far as the short-term value is concerned, which is what is of interest to swing traders, it's basically this red range here, which is right in the middle of where the current and 12-month future values are, as I would put it. When it gets into this halfway range, basically buy up half of next year's value, don't go any higher. If it gets higher than that, then prices are getting overvalued, and it gets more risk of a drop in price. And then normally when the price gets down into this green range right here in normal conditions, that's when buyers usually step back in. But now we still haven't gotten back up to that level yet where the price has stayed up here. But as you see, it took a while to recover. It did get all the way down to what I call the high volatility range and bounced last time. And mind you, when it did get down this far, it did go down below my even my bottom end here. But these other drops here actually were a little bit more reasonable as far as volatility was concerned. I mean, it was still high, but not as bad as this part here at that particular time. Because as I do updated earnings reports, update all the earnings data from all the companies in the index, these numbers all move up and down a little bit. So, in fact, later on in July and first half of August, that's where the most earnings reporting activity is going to be updated, and that's when we're most likely to see changes to the values of these. So, basically, for buy and hold investors, look for the S&P 500 to get all the way up to 3245 eventually. It's not going to necessarily happen soon. Like I said, it might take a year to get there, but it's still an uptrend, and you don't want to miss these kind of gains if and when it does get to that point. Now, if earnings growth expectations drop, this yellow line will come down and get closer to the white line, and when that happens, the red lines here will also collapse down toward the white line as well. If it's when the yellow and white lines are together, it's when we need to be a lot more concerned, because that means there's no growth expected in the next year. And even worse, when the yellow line starts to drop below the white line, that's when we see that, it's definitely it's a lot more likely to be a time to not be in stock funds, or very minimal in stock funds, if anything. But anyway, that's kind of covers the price target stuff. I don't want to have this presentation drag on too long, and I do have a lot to cover on even just a few technical indicators that I'm going to talk about. But just know that we're still barely even getting into the normal support level range where I would be a buyer in a normal situations. And so 3105 to 3140 range is where I'd be looking to sell. So without any changes to the earnings announcement, earnings reports from the S&P 500 constituents, that's the number I'm looking for, 3105 to 3140. So basically, when it gets into this range, is where I normally want to be wanted to swing out, as far as the earnings fundamentals are telling me. Okay, and then that support level, of course, it's at 3,000 to 330. It's just a hair under 30,000 now. It actually closed at 29.95 yesterday. So we're only 5 points away from getting into that support range there. Anyway, it's yeah, it should cover all the fundamentals part now. I'm gonna switch this over to let me. Okay, how about this? I'll just go back to the default and see if it comes back now. Cause yeah, I've been having problems with this. Okay, now I'm gonna add in my studies here, my study set for. Yeah, look at all these. Yeah, actually, this one here is the one I usually like to look at. Okay, there are three indicators here. One of them is the RSI that I talked about previously on yeah, when I was showing you the TSP chart or table, whatever. There's another one here that is called the average directional indicator. You don't see a hell of a lot of people using that particular one, but it does get used by some. And then the last one here is the moving average convergence and divergence indicator, or MACD. That one I made a reference to earlier as well. I do need to change the parameters on all these. I don't really like to use Wilder anymore. Actually, let's change this back to simple. Okay, so what we have going on here is I talked earlier about how moving averages were getting a little on the stretch side. Not really that bad yet, but it's getting there. If you look over here, this is a more noticeable area. Now, we're all the moving averages. You got the 10-day, the 50-day, the 100-day, and the 200-day here. See how they're all further apart from each other right here? And then when they all got close to bunched up together, here over here by when the correction bottomed out, yeah, the 10-day was down below because it follows the price a lot more rapidly. But the 50, 100, and 200-day averages were all bunched up right next to each other right here. And when that happened, you see the price came back up rapidly and then kept rallying up from there. And it had a little bit of a dip here back in March, early March here, but the rally continued all the way up until May 1st or April 30th, right at the end of the quarter there. Or not the end of the quarter, that would have been March. But anyway, the price dropped back down and found support at the 200-day moving average, and then it climbed back up from there. So this is why having these, knowing these indicators can be helpful, because if you're looking to buy in, a lot of times these moving averages, among other things, can be likely pivot points where the price changes from a downward trend to an upward trend. As you see here, it bounced right off its 200-day average and it went up. Okay, and now getting over here to the more recent end, you see we're getting a little bit stretched again. And like I was talking about earlier on the C-Fund data, see it's further away from the 10-day and the 50-day numbers and it was tripping the flags there. So, and that's what I'm getting at is there's a possibility it could come back down in the short term. Wouldn't necessarily expect it to drop that far, and I would also be looking at percentages here. Yeah, the price is at $29.95, but what kind of percentage does it need to drop to get down to this $28.50 level? Okay, well, that table I showed you earlier to give you an idea on what that, how much of a drop that would be. But now keep in mind, for every day that the price stays above the 50-day, the 50-day is going to come up toward the price as well. It's just the price is more likely to come down to the 50 more quickly than the 50 will come up to the price. So anyway, that's in a nutshell what we're looking at with the moving averages. I'm going to go ahead and move on because I want to talk a little. I want to have to go a little more in depth on these other ones to get you a better understanding of these. So relative strength index, like I was talking about earlier. You see here I have different parameters here. I got 10, 70, and 30 there. What that means is it's taking a 10-day period. So if I look right here, yeah, what this number is here, it's above. It's actually what's that? It's 73.09. So what it's doing is taking the last 10 days, 3, 4, 5, 6, 7, 8, 9, 10. Okay, so these 10 days here is what it's looking at to figure out that number right there. Okay, so basically, like I was talking about earlier in the other table, is 70 is considered an overbought condition and 30 is considered an oversold condition. And as you see, it's above 70 right now. Now, here's one of these examples of where just because it's above 70 doesn't mean it's a reason to be alarmed. See, we had a let's see, it closed. Where this pattern here, 2886 is what it closed at. I'm looking right here at this part right here. Closed at 2886, and then the very next day it closed at 2885. So basically flat, and then it came down to 2879. Not much drop at all going on there, but you see the RSI is still coming up. And I'm going to explain how more on that, because remember, this is a rolling 10-day period that it's working with, or 10 periods, whatever the interval is. And they'll work back up even from there, even with prices up so high. I mean, the RSI as high as it is, I got all the way up to over 90 here, and it still came up. And you see it came down some, even though the prices were still coming back upward. And that's all because of you were working with a rolling 10-day period. So if we're wanting to know right here, let's say right here, then it's factoring in 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So from right here, the trend, right where the trend reverses back to the upside, over to where this basically this doji is here, is what calculates that number right there. Now, why it was coming up, even though it was moving flat, is because this downward trend was disappearing increasingly more from the 10-day period when it was more heavily a part of it over here. So if you look from here, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. This is all downtrend right here, except for a couple of days. So that's why you saw the RSI down lower and actually falling still, because it kept, this short uptrend disappeared from the 10-day period in here, and then it became where it was just nothing but a basically 2-week-long downtrend. And then as you start to get an uptrend in here, you see it starting to come back up, but it's still low. So that's one of the things you got to really understand about relative strength index, and all of these oscillators. Just because they're indicating one thing doesn't mean that it's a warning that something a trend a pivot point's going to occur. Like I say, just if it goes sideways, for example, what are we dealing with here? 3, 4, 5, 6, 7, 8, 9, 10. Okay, so if we keep trending sideways, the uptrend that was right here is going to work its way, basically work its way out of this calculation. So if we just go sideways on the price right here, this RSI is going to drop back down into the normal range. So that's, again, this is one of the caveats of technical chart analysis, and basically making moves based on what single indicators are telling you, and not looking at a bigger picture perspective. It's good to know what's going on the technical side here, but it's a lot better to know what's really going on throughout everything with earnings fundamentals. What are the speculative traders focusing on, like the U.S.-China trade stuff, or anything else like that. All those play a role. It's ultimately the earnings fundamentalists are going to dictate what goes on in the long term with these prices, but technical chart traders and speculative traders are all going to play their own roles in what goes on in the usually more short term. All right, so anyway, I'm going to move on to the average directional indicator. You see, it's another 10-day figure. Basically, all it does is tells you how, there's normally a couple of other indicators in here that there's usually a plus indicator and a minus indicator. I don't have those set to show up in here. Actually, let me see if I can add them in. No, this one's set to only show that one. Okay, so normally there's what's called a DMI plus and a DMI negative in here. So, and basically whichever one is higher than the other tells which direction the trend is in. So, the idea here is to follow the trend until the trend is no more. So when the trend disappears, then you want to, then a tech trader would be more likely to trade, move out of their position or enter a position that they're not already in. As you see right now, when it's coming down here, it doesn't mean that we're in a downtrend. It just means that the trend itself is weakening. So we were in an uptrend, as you see here, but now it's basically giving little hints that the trend is losing some strength. It's still going upward though, but it's just not as fast. So that's all that means. If it gets down into a much lower area here, this is where, if I remember right, when there is no trend, that's when a lot of the tech traders are more likely to make some of their trades. Yeah, I'm not the most advanced on my experience using this this particular indicator. So like I say, I don't have as much interest in the technical analysis side as I used to anyway, and there were certain indicators that I was a lot more likely to use and understand, like this relative strength and the MACD and all that, and not so much ADX. Anyway, we'll move on. Like I said, I don't want to keep dragging this on. Okay, now MACD, there's a few other parameters in here, 12-day moving average, a 26-day moving average, and it's basically, there's another, basically, that goes over a 9-day period. So yeah, basically these two lines here, there's a, I forget what the one line is called. There's a signal line and there's another line, and then this is basically the histogram I was talking about in a way. So when it starts to go from a positive to a negative, that means that the trend it's likely to turn into there's a possibility it may reverse its direction. So as you see, when it turned red here, it was really dark red. Yeah, it was still in a downtrend. There was a short-term uptrend here, but it was still trending downward from here down to here. But when it bottomed out here, the histogram was just about to flatline here, right at the zero line. And also the signal line, actually, it was just getting ready to cross back over the indicator line. So when it crosses back above, that means, and this happens, this is a textbook example of where you want to be making a short-term trade to move back toward the upside when this is going on here. So as you saw, it did trend back upward. This is where it got its most strength right there, and now it's losing its strength, but it's still coming up, and now it looks like it's about to flatten out. May get another day or so, or another, I don't know, day or two of uptrend possibly, or before we could see a reversal. So we have several indicators kind of giving similar signals here, so it is a sign that it might be a decent time to make a swing trade. Now, something that a lot of swing traders don't keep in mind is that a lot of the adages that are commonly made reference to, like never catch a falling knife. They don't have an applicability so much on stock index funds like we're dealing with TSP or with or S&P 500, for example, this index here. They're a lot more applicable to individual company stocks, not so much to index funds. Okay, so I understand that, yeah, there are some adages, but some of these adages might apply to a different type of investor, with a different focus than what you're focused on. All right, so don't fall prey to some of those stupid adages. Index funds always go upward in the long term. So if you get caught making a bad move out of stocks, for example, there's no way to know if you'll ever get that price back at any point in time in the future. There could be a time where you're forced to buy back in at a higher price. And normally, my thought as a swing trader here. Alright, as far as swing trading, if you're going to sell out at all, swing out to a G fund or out of stocks if you're not talking about TSP. Don't sell out unless you're absolutely certain you can buy back in at a lower price. Otherwise, you just completely wasted your time on a move. If you swing out and then wait for a trend reversal, but then you don't get, and you're looking for confirmation of the trend reversal, and the trend reversal, the confirmation doesn't come till after the price has already gone back up above your original exit point, then you just made a really bad set of moves. You don't want to be selling shares and then buying back fewer shares than you originally sold with the same money. The idea here is if you're going to swing trade at all, uh, do it with selling your share, a certain amount of shares in mind, and knowing that you can buy back more shares with that same money you just got from that sell. So if you have $100 of, or yeah, let's just say $10,000 of maybe a $50 S fund or whatever. Then you got what, 200? Yeah, I think 200 shares. All right, well, don't make that swing out if it's going to cause you to. If there's a possibility of in any way that you're going to have to buy back 199 or even fewer shares. So make that move only if you can buy back 201 or more, for example. But of course, now with TSP, we can buy fractional shares. So even fractions of a share more than what we sold is a plus. And this is what my personal swing trading philosophy is. If I'm going to do it at all, make absolutely certain that prices are not likely to go up much more or run away to where I have to buy back at a higher price than I want to, or than what I sold at actually, and make absolutely certain I can buy back more shares. It doesn't matter to me if I can only buy back 1 or 2% more shares, or if I can buy 5% or 10% more shares. It doesn't matter. If I'm buying back more shares than I sold, I'm in better shape than the buy and holder is going to be. And that's what my main benchmark is how can I do against the buy and holder and 100% in this one particular fund. All right, I'm not saying that I'm trying to beat them necessarily, the buy and holder, but that's then again, that's the truth. I wouldn't be swing trading, and if I didn't have fun, I didn't think it was fun to try to outperform the market. So that's the whole thought on that. Right now, as you saw there, I have both the earnings fundamentals and some technical indicators there to look at. The earnings we're not there yet as far as I don't see enough in the price activity there to make me want to be a seller. But on the technical side, I definitely do see some reasons there to think that, maybe a slight downtrend could be possible soon. Now, also on the earnings side, there's something to be considering here with, like I said, because I'm thinking about possibly swinging out from the S fund over to the G fund, which is the government bonds fund, of course, and then eventually swing back into the C fund. I like the S fund still. I still think it has a better economic conditions right now to work with, but what investors are doing with the price on it and making it it's basically more unpredictable, makes me a little bit more hesitant to want to keep messing with it. So I took a risk, and even though C fund was my benchmark, and normally I was always jumping straight from C to G or G to C, whatever, and that was it. There have been times where I go half and half or whatever, to an extent in both CNS or exclusively in S like I am right now. But I'm looking for a little bit more predictability. Like I said, my philosophy is to be mistake-free. Even if I make small little pissant gains here and there over what the buy and holder is getting, it's still better shape. Like I said, I can do 4 or 5 swing trades a year, get only 1% extra out of every single swing. Guess what? I'm still in 5% better shape than the swing trader is going to be, or than the buy and holder is going to be. Actually, even more than that, because you get more on the way up than you do on the way down. It's a lot easier to lose money than it is to gain it. So, a good adage here: if you go from a price of 100 down to a 90, you just lost 10%. But when you go from 90 back up to 100, you gain 11.11%. So, even though the same numbers are in play, and you're going from the same from A to B back to A kind of level, if you miss the 10% and you get back in at the bottom, you get more back on the way back up than what you would have lost, basically. So if you can avoid any of those losses at all, that's part of the idea behind swing trading. And again, it's risky. You might swing out and the price keeps going up and may never come back to your level. Or you could hold on too long and take a drop down, which I'm okay with doing that personally. If I know that the earnings side is telling me that we should still expect an uptrend, I'm going to stay in there. I'm not going to take a chance of moving out just because the price dropped and make a bet that it's going to drop 5% or 10% or whatever. A normal dip is only about 3 to 5%, and a lot. There are plenty of others that won't even go down to 3% before they rebound. So that's why I say be really careful with these swing moves if you're going to do it at all. All right. That's all I have. I think that should cover all this. I hope you got a lot of great information out of this. Please ask any questions, any comments, whatever. Let me know how helpful this was. Thanks.